And welcome to Zoom Out with TouTzuSays. I'm your host, Robin Lin, and this is the Q2 2023 Outlook. And let's just hop in and get started. Let's see now. Okay, I hope everybody can see the PowerPoint. Welcome. This is the Q2 2023 Outlook. Starting with disclaimers, as per usual, don't take this as investment advice. Past results do not indicate future results. Remember that I'm biased, I have blind spots. This is for your entertainment only. This is not investment advice. All right, so let's just get started. Ta-da! Now, with 5% inflation for free, credit crunch. Here's the theme of what we're going to be talking about today. But first, let's get started with what happened in Q1. Okay. Overall, the stock markets did pretty well. The S&P 500, the NASDAQ were both up in Q1 despite poor earnings and despite a banking crisis that developed. What's interesting is if you look at what actually went up, only the top 5 companies in the S&P 500 actually really went up, and they went up by a lot. Everything else just kind of didn't do it. So basically all of the S&P 500, all the NASDAQ were concentrated in just a handful of stocks. You can probably guess what they are, those big mega cap tech stocks. What's interesting that a lot of people probably didn't notice was suddenly there was a lot of bond buying. A lot of people started going into bonds in Q1 because fears of interest rates hiking, fears of recession, et cetera, et cetera. So in reality, behind the scenes, a lot of the institutional players started getting rid of their stocks and buying bonds. When you take a quick survey, the outlook by investment professionals is not super bright. Here's the most recent survey results. I think a lot of people think it'll be in the 4,000 to 3,500 range by the end of the year. We'll see how that actually plays out. But I wanted to share this with you to just show a little bit of the pessimism that the professional Wall Street investors are considering. And to back that up, hedge funds are also right now net position negative for the S&P 500, which is quite telling. This is a double-edged sword. They could be positioned for a downside, but if the market keeps going up, they will have to flip, and then they have to buy the S&P 500, which pushes it up even faster. So let's see how this plays out. Globally, you're seeing housing prices, real estate prices fall precipitously all over the world. It's not just in the US. So there is a re-rating of everything as interest rates rise all over the world to fight inflation. Investments that require leverage, require borrowing. Well, all those borrowing costs shot up. And if you have to refinance those borrowing costs, let's say your loan was for 3 years. After the end of 3 years, you need to either pay it off or refinance it. Those are causing a lot of ripples in the global economy. Real quickly, just to toot my own little horn, how have we done with the crystal ball predictions? Last year in June, I predicted these factors: high inflation, interest rates rising, bankruptcies rising, unemployment rising, stagflation, recession, social unrest, defense spending up, the Ukraine war being a long war, and that commodity scarcity will persist. I think we're pretty much still on track as of April 2023. Okay, so what should we do now? Q1 is finished. What are we doing now? How are we going to position ourselves? I think the key factors that I'm considering are these 5 factors. Recession, shallow or deep. Inflation, is it going to go away or is it sticky? We have the US political situation. We have markets, specifically about liquidity in the US dollar. And we have US-China relations. Obviously, the war in Ukraine is a big unknown. We don't know how that's going to play out. But as of now, if the stalemate continues and maybe they get to a negotiation, that would affect things. But the West and the Russian alliance with China they're pretty positioned with what they want to do. Russia still wants to win more, and the Ukrainians are fighting heavily to prevent that. It's pretty much a stalemate. I think that I expected in Q1 a stronger Russian offensive. Well, they definitely launched a big offensive, but it wasn't very successful. Now we're kind of waiting for the mushy, wet spring to dry out before either side can have dry land start land offensives. So probably we're going to see a ramping up of warlike activities again in May when the ground is more firm and tanks can move. Hopefully it's not as deadly as it used to be, but I think that offensive is picking up for the summer. Anyhow, let's start with the recession. Is it shallow or deep question? And here is where the something cracked number one happened. This is the credit crunch cycle. Okay, so reflecting back into January, we had a deposit flight from these banks, and it caused them to go bankrupt. And this was so quick and so sudden that a lot of people were surprised and very fearful of what's going to happen. Somehow, it's been limited to these 4 banks, although the entire U.S. banking sector is under stress. If you saw my talk about the banking crisis, you'll know that overall, all U.S. banks are still under duress because overall, all U.S. banks were required to buy U.S. treasuries as their investment assets. That's the only thing they could buy. And because interest rates rose, all of those assets, if you had to sell them in a fire sale, sell them tomorrow, you would lose money. Okay. So that's the situation where any bank run, any flight of deposits could possibly trigger another round of these banking stresses. And the deposit flight thing is pretty serious in the sense that all the big banks, they're maybe paying you 0.5% on your current savings account, whether that's Wells Fargo or Bank of America or whoever, but also all the online banks and other money market options, they're offering 3.5, 4%. And so money is quite wisely moving out of the banks into those other options that are earning high interest. What that means is for any of the banks in the US, they are fighting to keep as much of their deposits in their coffers as they can. That means they're going to cut cost, they're going to restrict lending, and try to preserve the deposits that they currently have. So there's a big competition for that going on right now. Anecdotally, a friend of a friend who had a 30-year relationship with a local bank, he's a contractor and great reputation, great relationship. They pulled his credit line because of all of this. And so he's stuck with a half-built project in dire need of private financing, but that's just what it is. So you're going to see this credit crunch show up in, excuse me, commercial lending, just like the story of this friend of a friend that just happened, that will automatically slow the economy. We're going to see this show up in U.S. commercial real estate as well. There's a lot of commercial real estate, especially the sector not of office buildings. Through COVID, we've had people working from home. The occupants, the vacancy rates are in big high-rise buildings are much, much lower. Occupancy, people working from home, it still hasn't recovered, and their loans are due. There's roughly, say, $15 trillion of commercial real estate loans out there. And every year you're going to see up to 400 billion of that needing to be refinanced. When they can't refinance because interest rates are now so high and the rental incomes are not going to be as strong as they used to be, you're going to see some pressure there, maybe some defaults and bankruptcies, and that will also probably slow down the economy. The last little part, which I have less information on, but I do understand that the futures and derivatives markets are $1 trillion markets. A lot of times, when you are investing in futures, the leverage that you can use there is like up to like 100 times. You could put down 10% to buy $100 worth, $10 to buy $100 worth of a futures contract. There have been stories of, for example, nickel is stored in these special warehouses, and we trade futures contracts on them. JP Morgan came out and just announced that, hey, they thought they had, X hundreds of millions of dollars of nickel in these warehouses, and they found out that what they had there in the warehouse was fake. It wasn't even real nickel. It was, lumps of lead or whatever it was. So those type of things happen. They cause stress, and so far nothing is blown up. However, because it's such a highly leveraged sector and market, is this something where something might actually break precipitously? Just keep that in mind. So to reinforce what I was talking about, US banks are sitting on unrealized losses of about $600 billion. So they have to buy, after the 2008 financial crisis, the Dodd-Frank rule said you can't just take your deposits and invest it in anything you want. You can only invest it in A, B, and C, US treasuries, mortgage-backed securities, quote unquote, guaranteed and backstop by the US government and things like that. So that's what everybody did. Any kind of extra cash they had, they would put it in all of that. And then interest rates rose the fastest it's ever risen in US history. We're up at 5% now. And all those things that you bought during that period that were earning you 1% or 2%, well, they're worth less because today the interest rate is 5%. So if you were to sell them right now, immediately, you would lose money on it. That's kind of what happened to Silicon Valley Bank. Unprecedented. In one day, they had withdrawals of deposits of $42 billion. And they basically were forecasting $100 billion the next day, and that's when the Fed stepped in. So what can you do when everybody wants to take money out quickly? I think this is part of the Fed's and FDIC's issue that, for one, they didn't really manage the interest rate risk thing when they were doing all the stress tests. And second, I don't think anybody realized what the modern financial online banking system meant until now, where literally on your cell phone you could move billions of dollars in a day. And those two factors are what probably drove these banks and the Fed to step in. But have these issues been removed? Not really. There's a little bit of a backstop to some of those banks, but it's not a blanket backstop that they're offering to everybody. So okay, watch and wait. Let's hope no more banks really have issues. And if they do, does the Fed, does Secretary Yellen step in and backstop them? This is still a question mark. Okay. Now, since the banks had those issues, bank lending has rolled over. So as I mentioned, everybody is cutting costs, cutting their lending risks. They're just trying to hold on and hunker down to survive this period. So lending in the US is just, overall, all banking sector, all banks are restricting their lending. Commercial bank deposits have dropped precipitously, and a lot of that money is actually moved towards money market funds, which are, like I said, paying 3.5%, 4% interest on your savings. So it's much more attractive for the average Joe, and banks are so far not matching those, and so they're losing deposits. Now, a lot of people on Wall Street believe that the credit crunch has begun, and we're going to see tightening credit standards, much less lending, and we're probably going to see the effects of this in the economy very, very soon. So definitely in the next 3 months, the lending into the economy that keeps everything going is going to be severely restricted. When we look at the small businesses, which are the majority employer of humans in the United States, they are not feeling good. Is this a good time to expand your business? It's gone negative. When you go negative, and the availability of loans to these small businesses has also dropped to negative levels. Very not good. Banking crisis leads to credit crunch, leads to business bankruptcies. This is just a typical pattern that happens. I think we're just beginning to start to see this really come into effect, the real effect of raising interest rates so quickly and so high. As a reminder, even the public companies, let's say in the Russell 2000, the 2000, major companies in the US that are listed, up to 40% are unprofitable. And if they had borrowed money to run their businesses, and they need to either pay off their loans, or they need to refinance their loans, well, that could get more and more difficult. Refinancing will cost a lot more because interest rates are much, much higher. And if they don't have the sales and income to pay off their loans, then they really don't have much choice other than to go bankrupt. So extremely high number here, definitely worrisome. Something that a lot of you may not know is that big banks and small banks, they do different kind of lending. What's really telling, though, is the small to mid-sized banks do 80% of the commercial real estate lending in the United States. So this is very worrisome. As I mentioned, all those big high-rise office buildings that are out there, who lent them money to build it and rent it and run it? It was the smaller and mid-sized banks, and they're on the hook. So if, excuse me, the borrower, let's say property manager A, let's use a name called that's well known in the financial world, Brookfield, which is a huge real estate and property manager. Yeah, they have actually been letting a lot of their loans just expire. And what that means is they say, whoops, I can't pay it, here are the keys. And it's been in the news several times now. There's a big one in LA that was taken back by the banks. And there are other properties around the US that are slowly, this is happening more and more across the US. So you can imagine the stress that is building, and a lot of people, especially the real estate professionals, are very concerned about commercial real estate turning very, very bad. And Blackstone thinks it, this is HeartNet, I think he's Bank of America, et cetera, et cetera. There could be serious issues developing for the rest of the year, okay? And specifically, the office properties for commercial real estate looks like the one that is most in danger, just because the occupancy rates are low, and vacancies are high still. And if we have a recession going on, the hiring and all that stuff will slow down. So it's not a good outlook for the next year or two. Broadly, percentage of properties being written down. Yeah, we're getting a spike, and then we'll see how the rest of the year goes. But the guess is that that will continue to be going up. Meanwhile, the unemployment rate has remained relatively sticky around 3.5, 3.6. However, you're now getting first the January adjustments of jobless claims and unemployment rates. They make seasonal adjustments, and they tweak things out. It always worse at the beginning of the year, and then they make revisions. Well, this is a pretty big revision, as the initial jobless claims they thought were around 200,000 or so. And now they've revised it up over to closer to about 250,000. That's a pretty big gap of what they think people are, of how employed they are. If we look a little bit more at the different sectors of where job losses have been happening, All the tech sectors, financial sectors, a lot of the service industry is losing jobs. And we're seeing jobs maybe growing a little bit in the energy and the pharmaceuticals. Automotive is confused. In any case, you would imagine that a lot of the big mega tech companies are cutting some of the fat, and those are the higher paying jobs. Service jobs are still in demand, as we just need people to keep things running. But as the economy slows, that growth rate will definitely slow, and maybe they'll start to lay off as sales start to fall. Okay. A bit more wonky. You hear about this in the economics and Wall Street about the yield curve being negative. It is still negative, and whenever it's negative, historically, it is a harbinger of a recession. So I just wanted to show you to say that yes, we are still negative. And interestingly, what happens a little bit before recession actually hits, it gets less negative, and that's more a sign of bond investors saying, okay, recession is really now coming. I'm going to lock in my high interest rate loans or bonds, and they start to buy those things in earnest. Here's a very interesting piece of data that just came out, I think a day or two ago. Bank of America, JP Morgan actually said, hey, credit card spending, consumer spending has been actually pretty solid. It hasn't really fallen much. This is very interesting. We'll see how that plays out. This kind of goes back to my original thesis that you may have heard in previous sessions with me. The unemployment rate is sticky low. There's just not as much labor as there are needs for people to work. We lost a lot of baby boomers to retirement. There's a whole generation of young males who are just not in the workforce. I don't really know what they're doing. Maybe they're just at home trading or something. And obviously a lot of caretakers taking care of kids or the elderly, they're not back in the workforce. So there's a whole bunch of reasons why the size of the labor force has shrunk. But compared to the number of jobs, it's still a mismatch. Therefore, wages continue to be, relatively high, and unemployment stays relatively low. And this could be part of the reason why the spending is actually fairly stable. Moving on to inflation. Is it sticky or transitory? I showed this last time. I'm just going to quickly recap because I don't think anything has changed. However, I think these are the major factors for that inflation deflation discussion. All the fiscal stimulus that we did for COVID, that's ending, and that is no longer inflationary. It's probably inflation neutral, if not a little bit deflationary. With the US monetary stimulus being removed by raising interest rates and enacting quantitative tightening, which means the Fed is actually taking away or reducing their balance sheet, they're selling their US Treasury bonds. That is a deflationary force, and that's part of the reason why they do it. They want things to deflate. Okay, but when these things don't work in conjunction, the effect is often not always as we plan it to be. Labor shortage is an inflationary force. Supply chain, those interruptions are pretty much all fixed. Right now, shipping rates across the world are super low again. There's just not that much demand, so that there's no inflation there. If not, it might be slightly deflationary now as the shipping rates have come down. Commodity scarcity, it's still there, and it seems weird because the prices come up and have come down. They're starting to rise again, but overall, if we look longer term, this is a strongly inflationary force as energy and agriculture and metals, all of these are under duress. Demographics we talked about, the aging population is deflationary, but we have rising wealth and youthful populations in emerging nations. Those are inflationary. deglobalization as a mega trend is inflationary. It means that you used to be able to just rely on China. China built one factory to make all those widgets. Well, now we have trade wars and everybody's splitting apart. We don't like to work with China or depend on China. So we need to build that same factory in Europe. We need to build it in the US, maybe build in Mexico or wherever. You're building 3 times as many factories. You have to hire all those people, pay different wages. That just all costs a lot more. So that is an inflationary force. China has also reopened. Their economy is doing well. But now, as they use up all the inventory of the stuff they had, their PPI, which is like raw materials inflation, that is rising. And as that rises, that means the cost of what they're making is going up, which means they also need to raise their prices in order to maintain a profit margin. So net, that is an inflationary force. The US dollar, depending on who you're trading with, but if the dollar is strong against the euro, that's a deflationary force. But right now, as it looks, the US dollar is weakening. And as that weakens across the board, that means anything that we buy costs more. So yeah, that's an inflationary force. Wars are always inflationary. OPEC recently just announced another surprise production cut. That's inflationary. Geopolitical risks, it just means you need backups and extra inventory. It's not great use of your capital. You can't do the just-in-time inventory system management anymore. You need to prepare for the worst, and that is always inflationary. The last one is just, nobody knows about the climate change and weather patterns, but there are a lot of smart people who do a lot of analysis. I think it's fair to say we had 3 years La Nina. Now we are most likely going to have an El Nino year. Forecasts, again, from bright people, but whoever knows, they are forecasting an El Nino for 2023. And El Nino years tend to be extremely dry for the US. And we're already seeing massive heat waves in India and China right now as these El Nino, La Nina forces transition. So overall, it's a challenging thing, especially when you consider that the harvesting period and the planting period, those windows, it's extremely critical to have the right weather. And when you miss it, you miss it. And that's just what it is. Net, I think you can tell that I believe our inflation issues are not transitory, they're sticky. I think what happens this year is inflation does come down gradually, I think to around the 4% level. But I'm feeling that inflation is going to go back up end of the year into next year because of these factors. Okay. So as I mentioned, China's PPI, the cost of their materials to build and make things, that is going up, and that is going to show up as higher prices for every export from China. Here's somebody who put together this chart. Myth, the end of oil is near, but in reality, there's no scenario that experts predict where you don't at least maintain or use more oil into 2050. And that's an important insight and thought. I think this is driven, again, people think about maybe the US or the advanced nations, but in reality, when everybody in Indonesia or in India gets wealthy and stops using a bicycle and buys a scooter or buys a car, that's just driving all sorts of oil and energy prices. Maybe they can leapfrog and use electric cars, electric vehicles, but even electricity requires some form of energy to create it and create electricity. So that's not a given that they will all make that jump and leapfrog through that. As I mentioned, OPEC had a surprise production cut announcement that was only a few weeks ago. So oil prices immediately went up after that. This is a very many-leveled tactic. This is supportive of Russia because now oil prices are higher. It is a big middle finger to Biden. Saudi Arabia has decided they are not going to just do whatever the US wants. They've really been going their own way. And even just redefine the Middle East. There is a huge rivalry and conflict between Saudi Arabia and Iran. Well, China just helped them broker a peace deal. Looks like it's going to stick. Saudi Arabia reached out to Syria, reached out to Yemen, all the areas where they've had existing conflicts, and their intention is to de-escalate all those tensions and start to focus on a peaceful interaction and a peaceful lifestyle there. That's a huge, huge shift in geopolitical structure, and we'll see if that holds. But for the time being, it's a real shock, I think, for the United States, which has never been able to achieve that kind of peace, or maybe they never wanted to achieve that kind of peace. But in any case, it's a little bit of a surprise for me as well, because I thought that region will remain in tension, but it's looking like it's de-escalating in tension. Recap of some old slides again. The metals that you need for electrification, they may be mined all over the world, but they are all processed pretty much in China. And without specifically copper, you can't electrify. All the power lines, all the batteries, they require huge amounts of copper. And the orange line is current inventories in 2023. We're far below past ranges, and there's no indication right now that any of the copper mines are eager to go and dig some more copper for ecological resistance reasons, for cost of borrowing money to open new mines reasons, and also for price reasons. They want to see prices really shoot up to extreme levels before they say, hey, yeah, we'll start to mine some more. And they want to see that the demand will be long term. So this is something that really I've been talking about for a while now. I think there's a huge potential in copper and some of the other metals, and we'll see how that plays out. Quick heat map of ocean temperatures around the world. As I mentioned, the El Nino seems to be building. It's not confirmed yet by all the weather agencies around the world. But it's definitely a factor, and it's picking up, and that's why we're worried about in the summer there could be a severe drought in the U.S. There's already a massive heat wave over here, and this is a cyclical thing. I do want to say this is not just climate change and human-created greenhouse gases. Remember that La Nina, which happened 3 years in a row, the previous 3 years, that meant the ocean temperatures dropped. And it doesn't mean that, the humans suddenly stopped producing all these producing all these climate heating things. It just means there is a cycle in the oceans as well. And another factor that happens is also the solar cycles, as we've had fewer sunspots over the last 3 years, but that cycle is starting to pick back up. We're going to get more sunspots, which is blasting all this radiation and heat and energy towards the Earth. So that will definitely have a factor in all of this as well. Okay, let's talk about U.S. politics. This is another big unknown, but I'm very concerned about this. I see this as something cracked too. The U.S. debt ceiling. So to educate everyone, the debt ceiling was put in place to limit the amount of borrowing that the U.S. government could do every year. So we didn't want rampant, let's just borrow a whole bunch of money and then, just to juice the economy and make Democrats or Republicans more attractive. So they implemented a debt ceiling and I forget when it was, I think in the 70s or something like that. And whenever we run into a debt ceiling, Congress must do something about it. They either reject it or approve it or raise it. So we breached our debt ceiling in January of this year. Okay. Right now, that means the US Treasury, the US government is not supposed to borrow any more money. And when they borrow money, they issue US Treasuries to borrow money. Now, during the COVID era and the last couple of years where, the stock markets, house prices, everything went up, that meant also that tax income for the US government went up. And what they did was they filled up this little piggy bank called the Treasury General Account, the TGA. And we've been using that account since January to pay for things. So we're paying Social Security, Medicare, all the employees at all the US agencies, et cetera, et cetera. We've been paying everybody out of this TGA. And right now it's running lower. And the forecast by some on Wall Street is, maybe around June, it might run out. Okay. And if it runs out, that means the US Treasury will need to stop sending Social Security checks and stop paying Medicare and stop paying, soldiers, stuff like that. Okay. A big concern. And as the US budget deficit rises, it means our tax receipts are less than expenditures. Okay. That means the US Treasury needs to borrow money. And I suspect, like past debt ceiling crises, Congress will eventually raise the debt ceiling. So whenever they do that, they have to negotiate it. They get, right now the Republicans are negotiating terms. They want to raise it to $1.5 trillion debt ceiling for 1 year. And the Democrats are going to counter. This negotiation probably will go down to the last hour, last minute. But I suspect that it will get raised. And that means once that happens, I believe the Treasury is going to say, okay, our TGA account, our piggy bank is running dry. We need to borrow some money to get everything going again. So they will issue new US Treasury bonds. Now, here is the tricky part. I suspect that the Treasury bond supply will greatly outweigh the Treasury bond demand, okay? And this could present a huge problem. So internationally, we've had COVID. That means the US is not buying as much stuff from other countries. Therefore, they don't have as many US dollars. That means they don't also need as many US Treasuries, okay? So overall, I think that's been the situation. And then on top of that, Russia and China have strategically been not buying as much US Treasuries. In fact, Russia doesn't have any more, I think. I think they got everything out and they just bought gold. China still has US Treasuries, but they're definitely not increasing the amount that they have. They've been reinvesting whatever US dollars they have into other things like commodities or oil or et cetera, et cetera. Okay. So overall, the demand for US Treasuries internationally, I would forecast as flat to low, okay, especially if there's a global recession. Domestically, we just talked about how the US banks, the crisis that we just had with the bankruptcies, they were forced to buy US Treasuries because they had too much of deposits and they didn't know what to do with it. And it was the safest bet to earn something. And that was all hunky-dory when interest rates in the US were near zero. Now, interest rates are so high and the bank run risk is not gone. They're holding on to their cash, okay? And I don't think that they want to jump in and buy a whole bunch of new US Treasuries. They'd rather manage that. I think the domestic demand is going to be down. I think commercial bank deposits are going to be down. So I suspect that those two things added up mean that demand is going to be less than supply. Okay, and here's the economic wonky part. When demand is less than supply, you need to entice investors by offering a higher interest rate. Okay, so that's why I have here US Treasury yields go up. So maybe the Fed fund rate is at 5, but if nobody wants it, you can buy it and then sell it. You would have to sell it at a loss, basically, to get the yield up, to make it attractive for an investor. So as these yields climb, that means for the US government to pay those interest rates, they have to pay more than they ever had to. And that becomes an issue as that debt service, that's what it's called, climbs to a really significant level. And we're seeing debt service already, approaching $800 billion. And I don't think it's ridiculous to consider in short order. We're going to be spending $1 trillion a year just to pay the interest on all of the money that we're borrowing in the US government, okay? That is untenable. That is a strategic national security issue, and that probably will trigger or force the Fed to do something that Japan has done, to enact the yield curve control. So what does that mean? That's a policy where they say, hey, we're going to keep treasury yields in this range, whatever they designate. In Japan, they keep it, in like a 0.1 to negative 0.1 range, something like that. And in order to enforce that, that means sometimes they're buying US treasuries, and sometimes they're selling US treasuries. Now, what happened in Japan is, at first people don't believe it, they challenge it, and then the Bank of Japan goes in and just buys even more of the government bonds, and it forces the yields to come back into that range. So essentially what it means is more QE, more liquidity. So I think that we're heading in this train of events. And as a reminder, when you get QE and more liquidity, overall, that is a positive for risk assets like stocks, okay? Is this a positive for the US government's balance sheet and our budget situation? No, it's not. And the other factor is if inflation is not slayed by this time, we'll probably see all this extra money come out, and that means probably inflation will rise again. Okay, so to recap, the TGA is down to about 140 billion, and we have a few more months into June. Interesting, April is tax day month. That means we're all paying our taxes, so the TGA will go up. Probably, I saw today, up maybe another 250 billion. But the bills that we pay in the US are pretty high, and I think Goldman Sachs was saying, sometime in June. Okay. The cost of paying for all the US treasuries, when we had interest rates stuck around 0, the cost was fairly minimal. Suddenly, once we raised interest rates, those costs shot up. They've essentially doubled already. And this chart is only up to January. So $1 trillion, I don't think it's a far cry from where we are, okay? There have been some who have said when debt service costs exceed the cost of your defense spending, bad things happen. And we're really kind of close to that, okay? Just a quick recap to show you how much debt the US has grown. Today, we are at a debt to GDP level of about 120, and anything above 100 is undesirable. So we need to really pay attention to that. Luckily or unluckily, we're not the only bad one in the neighborhood. Here's the US. UK and Germany are slightly better, but pretty much everybody else is well above the 100% level. Japan's at the 250% level. Not a good look. Let's talk about the markets and what might be a couple of key factors of liquidity in the US dollar. This is from cross-border capital, people that I follow for liquidity. They seem to be really, really spot on with their liquidity calls. And you're seeing them put this heat map together that, this is like QE, and then quantitative tightening, interest rates rising, et cetera, but they're starting to see money come out of the Fed, liquidity increase from the Fed. Bank of Japan has always kind of been, yield curve control. They're spending money to control their things. In China, since the end of last year, they've actually really ramped up the stimulus. So net, we're still in the yellow zone, but once it starts getting into the green zone, as other countries realize that they have issues and need to restart QE, we could have another big wave of risk assets really jumping up again, as well as inflation. Okay. Now, the dollar has been in the news a lot. There's a lot of buzz about, are we de-dollarizing? Is this a threat? Oh my gosh, are we losing our status as reserve currency? What does that mean? Et cetera, et cetera. So here are some headlines. I mean, Russia basically says we'll take Chinese yuan over anybody. So they're expanding their global trade levels of foreign reserves of Chinese currency. It's almost unlimited. Saudi Arabia, the Middle East, they're feeling more and more okay to receive payments in Chinese yuan. France even bought one big order of liquid natural gas from China, and they paid for it in Chinese yuan. Brazil and China are really getting chummy. The new president in Brazil, Lulu is his nickname. He's been very vocal about de-dollarizing and not being dependent on the US. He's getting very chummy with China. And the BRICS countries have all come out and, essentially said, we want to set up an alternate currency to the US dollar. They're all trying to get away from US high-level strategy that tends to be US-centric and focused on the US's benefit. They're all trying to avoid being caught in what Russia was caught in, being sanctioned and then cut off from the international financial system. So everybody's starting to place a few bets into breaking free from the US dollar's hegemony. What does that mean? Does that mean that, oh my God, the world is just moving away from the dollar? Yes and no. So the answer is yes, this is going to be a trend that's going to persist, I think. And we'll see how much it grows. But this year in particular, China has been very, very, very active in trying to get the dollar out of the picture and conducting trade only with their own currency. And so, yes, it is a worrisome trend. However, when we look at what really is going on, most of the transactions in the world are still in the dollar. And I drew these arrows. Yes, I think the share of international reserves, the dollar probably starts declining, and the Chinese yuan, they're pushing really hard and really strategically to increase their portion of the international reserves. But it's a long way. It's not a overnight type of thing. It's a very gradual thing. Why is that? You need 5 things: trust in the central bank, and at the end of the day, the people trust the U.S. and our central bank because we have laws and rules that make it transparent and are usually enforced. There's a liquidity element. At the end of the day, there are more dollars out there than anything, so it's safer. It is the most widely accepted around the world. I mean, at the end of the day, you might not like the US or not like the dollar, but your best chance of using those dollars to buy something else is the highest with dollars. There's convertibility. You can convert dollars anywhere around the world. And that can't be said of the Chinese RMB. Okay. That is, the Chinese yuan is still highly controlled by the central government. So you need to trust the central government there, that they'll do the right thing and that they'll, be considerate of your feelings, or, there's a risk that you might get stuck with, Chinese RMB and not be able to use it. And finally, there's a huge offshore market that needs to be there. Okay. What does that mean? That means, let's say a company in Brazil needs to borrow money. They could borrow it in their own currency, or they could borrow it in US dollars. And this US dollar offshore market is massive. And because of that, it's very, very sticky. So as the president of Brazil wants to move away from the dollar, the companies in Brazil are still stuck with the dollar because they borrowed in dollars. That means they need to pay it back in dollars. That means they still need access and flow of dollars. That doesn't go away quickly. Okay. So the installed base, the network effect of the US dollar is extremely, extremely durable. Okay. So the lion's share is still US dollars. When you have extra US dollars, you go and put it into something safe like US treasuries, because you trust that the US government is going to honor those agreements. So that's still by far the largest, deepest, broadest market in the world. Okay. You could have excess RMB, but what do you do with it? You can buy Chinese goods or you can buy Chinese bonds. And at the beginning, sure, it might work, but what if China doesn't like you anymore? What's going to happen? Those are risks that central banks and countries have to consider. And as I mentioned, the offshore US dollar market is massive. It's over $12 trillion. And that, like I said, it's a very sticky thing. This doesn't go away for at least a decade. It would take a long time for this to convert to some other currency. And let's not forget that we're in a conflict world, a deglobalizing world, and energy is valuable. Of course, the Middle East, Russia produced that, but the US does too. So the currencies that are energy exporters will always do better than the currencies of energy importers. Japan is one, China is one, India is one. They all need to import, and they're going to do that in the best currency that is good for their country. Okay, and just a quick chart of how the dollar cycles. They go up, they go down, they go up, and they go down. So yes, we're in a down cycle. I think that's fair to say, probably for the next year or two. Let's see what happens in that after that. Maybe the Chinese strategy works and the US dollar continues to climb, or maybe something happens and there's a misstep or there's a war and people rush back into the safety of dollar. It's just suffice it to say, it's too early to say that this is an imminent threat. I think the de-dollarization trend is real. I think it will continue to happen gradually, but we're nowhere near a tipping point where it would suddenly flip. Okay. Finally, US-China relations. This is always a fun one for me. There's no doubt China as an economy is going to continue growing. They're just a bigger, more people there, and they do a lot more global trade. So in 5 years' time, they'll probably end up being the largest economy in the world. Okay. This first quarter, the US grew minimally. China, coming out of their COVID restrictions and with all the extra stimulus that they had, they came out and said they had a 4.5% GDP growth in the first quarter. That's pretty good. We're seeing signs of industry, services, everything starting to ramp up like we did when we got out of COVID. People started spending on restaurants, going traveling, et cetera, et cetera. All that spending, that pent-up spending is starting to happen in China. And that's a good thing for China and probably a good thing for the world to at least have one growth engine in the world. As a reminder, China has become the largest trading partner for most of the world. So comparing from 2000 to 2020, in 20 years, China has just expanded its trade relationships with everybody. And you're seeing now China is reaching out to South America and say, hey, let's trade in RMB too. We don't need the dollar. And Africa, the same. Middle East, the same. Okay. Europe, Russia, obviously, right? Even India is a major trading partner with China. And we'll see if India would decide to do that with China. But I would suspect they'll keep the dollar. But in any case, China's really, really ramped up their power and influence. You know, Saudi Arabia, what they buy and sell, red is now China, blue used to be the West. It's definitely shifted. So their policy, their strategy is all shifted away from the US towards China. Oil imports for China, definitely they've boosted Saudi Arabia and the Middle East. There will be parts that here probably don't reflect that are Russia. But China is less dependent on the US energy than ever. Lots of key metals in Africa, and China has spent a lot of time developing and investing in those relationships. So yeah, that's another influence that they have. It is worrisome. You have to figure out how to manage that from the US perspective, but China has a foothold in all of these areas. And like I said, South America, whether that's Brazil or Argentina, China's become the major trading partner, and therefore they're using their weight to get their currency to be more prominent. I'll skip that one. However, it's not all roses and hunky-dory in China. They've created a lot of debt in their country as well. So $8.3 trillion of fiscal risk. So here's how it works in China. The government doesn't necessarily have a bunch of debt, but the government tells all the regions and cities, hey, do this, do that. And that's what they did. They all lent money to property developers and infrastructure makers. And there's a lot of money that went out that was productive, building that infrastructure, but a lot of it was not. And as their refinancing cycles come due, there's a lot of money that is kind of at risk, okay? So you're seeing total private credit, so not government debt, but private debt. The red line is by far and above the highest growth rate of any country in the world that is relevant, okay? Now, China being a totalitarian state, they've been doing a great job of not letting this blow up. But if they were ever to lose some control over that, that could be a massive problem. So just keep that in mind. They're not necessarily the cleanest shirt in the dirty laundry pile either. So they have their issues at home. Just a quick snapshot of recent tensions around Taiwan in the South China Seas. You're seeing US assets around here. You're seeing China having military drills, Russian military drills. China just got done with a lot of drills right around Taiwan. The US just sailed a destroyer through there just to say, hey, these are still open waters. Very worrisome. I'm really concerned that we're an accident away from something ugly, but there's a lot of activity going on around there, okay? So I had previously made these predictions geopolitically. I said Russia would have a major counteroffensive in Q1. They did, but it was a flop, so nothing really happened. Looks like they're going to have to wait for the ground to harden up, and probably sometime around this summer, early summer, we'll see some real battles that might swing the needle towards somebody winning or losing or going to the negotiation table. I said China would launch a major charm offensive, which they've been doing in spades. They're now positioning themselves as a global peace broker. Only China is able to reach both sides credibly. So in the Middle East, Saudi Arabia and Iran, only China could have pulled that off. And right now, even Macron, the French president, has begged China to step in and try to end the war in the Ukraine. On many levels, it's very ridiculous to do that, say that to China from the European. But Europe hopes that the conflict ends sooner rather than later. And the US is not really in a rush because while this war goes on, we sell weapons and energy and food. It's not so bad for the US. So you can see why that kind of happened. But in any case, China is very, very aggressively reaching out to the world saying, hey, we're the alternative to the US. We're not going to interfere in your stuff. We just want to trade with you, and let's do that. And it's a very appealing message to a lot of what is called the global South that have been fed up with being bullied by the US over the last 40, 50 years. Okay. China unclenching has definitely been boosting their economy. I was wrong about the Middle East. Saudi Arabia has taken an active role in trying to calm things rather than escalate things. And so now we'll watch about El Nino and how the US political situation resolves. Real quick outline of timing and trigger events that might be happening in the next quarter. We're in the middle of earnings reporting season right now, and it's a mixed bag. Net, I would imagine that by the end of April, it will be a negative picture. Earnings are going to go down, forecasts are going to go down. Bank lending to any company is going to go down. So we might see continued layoffs and cost cutting in this cycle. So that will be a negative for the economy. I think it's a negative for the markets as well, but we'll have to see. May 2nd and 3rd is the next big Fed meeting. They have been hawkish in saying they're going to raise interest rates more because inflation is still there and sticky. We'll see if that happens. I suspect that as the economic data slows, unemployment maybe goes up a little bit more, inflation comes down a little bit more, they may choose to pause. But I think by the June meeting, they will definitely pause. Okay, so that's my crystal ball. May 14th, there's a big election in Turkey. This is a big deal because Turkey is a big deal. Turkey is located in that critical juncture between Russia and the rest of the world. They control those waterways, they're a power player, and they don't get along with everybody. They've had tiffs with the US, they've had tiffs with Sweden, and they're blocking Sweden's from joining NATO. They do all sorts of interesting things, and who's in charge there will have a huge impact on global geopolitics. So we need to pay attention to what that is. If Erdogan wins again, probably status quo, we can kind of forecast that he'll just play both sides. If he loses, which is a real possibility right now, there was a massive earthquake in Turkey and Syria a couple months back. Really a bad look for Erdogan. He was on film saying that, yeah, he reduced the restrictions for earthquake proofing construction. He was really proud of it. That just really looks bad. So this I don't know enough about Turkey to know how that really is going to go, but I know that this is an important election for the world. So pay attention to that. I would imagine that if Erdogan loses and whoever the other person is, that will change global macro investor perspective, which could shift, all sorts of investment outlooks. And then finally, as I mentioned, June, July, US debt ceiling crisis. When it happens, before it's finalized, there's going to be a lot more stress and uncertainty. People are going to worry until it's done. Everybody will be elated. But after that, the expectation is US Treasury issuance is going to ramp up quickly. Okay. So here is my crystal ball. As I mentioned, inflation, I think, will start to fall, continue to fall. I think it flatlines around 4%, but I think it comes back, okay, in the next year or the year after. I think the US recession will be shallow but long, just because unemployment rates probably not going to skyrocket like before. And I think that, having people employed just keeps things going. People still need to spend on things to survive, and that keeps a certain base to the economy. Having said that, the banking crisis, this credit crunch, will have an effect on businesses in the US. And I think the Fed wants to still maintain its credibility and wants to fight inflation. They're going to continue to be as hawkish as they can be. But I think they're going to be forced into yield curve control by Q4. And that could be a major boost to risk assets again, and specifically the stock market. It would probably mean that inflation revised back harder and faster, and that's going to be a major conundrum for them in the following years, how to deal with that and then still try to control the yield curve. We'll leave that for a future session. China will continue to do what's doing, but by the second half of the year, they will be importing and exporting inflation. So that should be inflationary. I think the scarcity of energy and metals globally is still going to be there. In a deglobalized world, you need to build more factories, you need to reindustrialize, et cetera, et cetera. It just takes a lot of energy and metals. And that demand is coming, and it should be quite durable. US markets, I think we do get finally a real drop this month or into the next month. But as QE and yield curve control looks more and more likely, I think the markets will surprise to the upside by the end of the year. I do expect the US dollar to continue to weaken. So it makes US assets a little bit less attractive, but I do think that US tech will remain attractive globally. There are no substitutes for Apple's and the Microsofts and all the AI stuff that's going on. Right now, we're the only game in town, and that's high potential, high growth potentials. That money will still come into that. As an aside, when the dollar weakens, it makes commodity returns go up. It creates inflation. It also makes emerging markets also more attractive. Okay. Real estate, with the commercial real estate issues, I think we are going to mean revert downwards for all US real estate until we see yield curve controls and maybe interest rates going down. That might be towards the end of the year. Finally, El Nino, I put it here because if it does happen, we should expect a severe drought in the US, which could really, mess with our crops and cause other inflation in a period of recession, which would be bad. Okay, and where to invest? Slightly modified, short-term, mid-term, long-term. Yeah, things that generate cash. And money markets, I've added this because, gosh, if you're just sitting around in cash, earning 0.5, why don't you sit around in cash and earn 3.5? This is a real trend that everybody, the average Joe, is able to do easily. I don't think that trend goes away. And so have some cash parked over there. In the midterm, rearm, restock, reshore, regrid. Reshore means this generative AI robotics sector. This is, you may have been hearing about ChatGPT and all of those type of things. I've been really following that. It's a real technology trend. And we all need to be really cognizant of that it's coming, and it will be extremely disruptive. I don't think we see the full force of what that means in businesses and our economy until, it takes a while. Of course, the leading companies are going to start using and adapting it. They're going to get huge productivity boosts. They're going to need less people. But for the general broad economy, it's still going to be a while. But it is a major force of change, a very disruptive force of change going forward. This is great that right now the U.S. is one of the leaders, and but China is definitely up there with the U.S. in slightly different sectors of AI, but they're definitely up there. So let's pay attention to that. Longer term, again, still the AI, healthcare, electrification of everything, and then tied in with the Web3 and blockchain, metaverse, this big segment of stuff, NFTs. It has a foundation, and I think we don't really know what the winning killer app is going to be, but I think as these things all converge together, something amazing is going to happen. And want to definitely keep watch on that for the longer term. Okay, so that's it for today. Remember, don't panic. If you have any questions or thoughts, feel free to reach out. And that's it for today. I'm Robin Lin. Hope you enjoy your evening and week, and happy trading.